for those that say 7% rates are, they want to use this line that, oh, it's normal. It's, I remember I had 8 and 9% 30-year fixed rate. 7% mortgage interest rate is bad for this market. It's really bad. And anybody that tells anyone differently is lying. Unless they want home prices to come down 10 or even 20%, 7% interest rates push us above unaffordability zone above the 2007 level. Once you get back down to 6.5%, you're actually below that level. Time's different. We've printed a lot more money. I'm just not comfortable being above 07 level when it comes to affordability. And 7% every time we go above it, it pushes us over that number. So that's where I want to be in the high fives, regardless of what's normal or not. We just went through the most abnormal 2 or 3 years that put us in this situation to begin with. So we're creating a new normal. And to me, it's got to be a sub 6 interest rate, hopefully by the end of this year.
I think it gets there. It's got to, right? That's all I keep saying. It's got to.
Yeah. There's less projections that put it there. There's still some people holding strong on the high fives by December. But just we didn't think we'd be sitting, this close to 7 at this point in the year, so that's where some people have adjusted.
I understand that. I think, when you look at some of the stuff coming out, I think, the job stuff, I think was a little bit unexpected. Sorry, I didn't listen to last week's podcast. And if you guys,
it was actually Tom, wasn't it one of the best?
I mean, that's voted the best by the listeners. I have the data right here. Number 1 knowledge brokers of all time.
Salty.
By the way, we're about to hit 1,000 subs. So if you listen on YouTube, hit subscribe. That'll make Lisa feel good that she was on the episode that pushed us over the 1,000 mark there.
Okay. Yeah.
Okay.
Anyway, what I was saying was reading the stuff that came out with the jobs report and not that we ever want to celebrate joblessness, right? But the fact that there were more filings for unemployment was a good thing. The fact that, for rates and where that's going to go and maybe putting a pause on some of the increases. I'm feeling positive. That's what I'm going to leave this with. I'm feeling positive.
I like your outlook. I mean, I do. I don't know.
I'm thinking it into positivity, like in putting it into the universe, and it's going to happen.
Lisa is that powerful that her positive thinking will change the real estate market. Amazing.
And it's going to increase the number of subscribers.
Well, here's somebody who commented at Homes in Orlando on last week's episode. And Lisa, maybe we'll get your positive outlook on this. It says, what you are missing is the $1 trillion Yellen is putting into the market. Rates are headed up. So while we're talking about, we still, and I've heard this argument before, so this isn't the first time I've heard it, essentially and part of it has to do with the debt deal that we just put together. We got to go out there and get people to buy, our debt, other countries to buy our debt. And there's a theory that could push the rates up, not down. What would you say? What's your positivity outlook say about that, Lisa?
Oh, goodness. I mean, there's always going to be things. I'm focusing on the positive. I mean, truth be told, there's always going to be things that we need to keep an eye on, right? I think if they go any higher, it's clearly going to create issues. My gut says that I'm having a very, very difficult time articulating my thoughts at the moment. I don't know. I just don't see it getting there because I think the ripple effect that it creates of other troubles is far greater than some of the other stuff, right? I'm tongue-tied at the mo.
Yeah, no, I agree. I mean, if we got to 8% on the 30-year fix,
oh man,
that would put, based off the relationship, the 10-year at like 5.
Right.
So, I mean, I don't see that happening either. I'm just there's a counter argument that states based off of, where we're at and begging countries to take our debt on right now. There was a great analogy I heard about this where they have so much of our debt, so we have to make it more lucrative for them to take more of it. They already have so much, right? And we got to make it more lucrative for them to take it, which can push the rates up. But I mean, a lot of it depends on what happens next week, 13th and 14th, for the short term, and how the markets react to that. To Tom's point, 30% of the market is projecting an actual rate increase, while about 70% of the market is projecting that we will have a rate pause next week on the federal interest rate. And then we'll see how the 10-year reacts to that, and what that trickled into the 30-year will do next week. Tom, anything from you?
I hope we don't see 8%. I mean, that's not good. I agree with you guys. I mean, I just don't, given the spread on the 10-year and how far away the spread of the 10-year and the 30-year fixed rate on mortgages is, I mean, you're starting to defy economic history and economic principles at that point. And that's where, look, we've seen stuff happen before. A lot of this is just like it's the post come down of what's happening here, because they put so much cash into the market, rates came down. We saw what it did to this housing sales. This is a normalization. And I anticipate it going the way a lot of people think it's going to. It's going to be this softer sort of landing the end of the year. It's going to be gradual, and all the more reason for the agents listening that want to be knowledge brokers or are actually paying attention to what we're talking about. And I'd love to see some comments below about if you feel like you need kind of more of this advice. You got to have these conversations and talk to people about what the heck is going on. I mean, there's so much clickbait out there. I mean, Steve Harney was talking about how someone said foreclosures are going to be spiking. And then when you look at the actual number, it's less than we saw in 2019, 2018, 2017. It's just more than the unicorn market, right? So that's not a spike. That's a normalization. And I think you had a great point, Byron. Like, we had 8% rates. Well, the last time we had 8% rates was like in the 2000s. Home prices were a lot less then. So I don't care what anyone says. Yeah. Like, it still costs more, and you got higher numbers you're financing. So the math doesn't always equate. And 7% that's been where it gets uncomfortable. Look at what happened last fall. Rates hit 7% in October. And it was what did you call it, Lisa? A very cold fourth quarter in New Hampshire or something like that. I mean, it's what happened.